Here, I'm the host of the More We Know podcast for the Gen Zs and Millennials. I know I say it's for the Gen Zs and Millennials. And yeah, although that is the focus, this podcast is really for anyone. But I look back at my time in college and I wish I had something like this. I wish I had a podcast where I could learn from mentors or experts in their industries, or, fellow Gen Zs that are talking about real world topics, that are talking about what is a credit card APR, what is investing, what does all this mean?
Welcome to the More We Know podcast with your host and social media influencer, Mir. Gen Zs and Millennials.
Welcome back, everybody, to the More We Know podcast. I'm your host, Mir, and today we have a phenomenal guest. As you know, thousands of listeners come to tune in monthly to hear from mentors from all around the world. We've brought on people like the mayor of Miami, the founder of Reebok, and today we are shifting into the capital markets with a phenomenal guest by the name of Daniel Ives, who is a managing director and senior equity research analyst covering the technology sector at Wedbush Securities since 2018. Dan has a plethora of experience. He's been on Wall Street for 2 decades covering the software and broader tech sector. He spent the first few years of his career as a financial analyst at HBO and then received his MBA in finance before becoming a well-known tech equity research analyst and managing director with FBR Capital Markets for 16 years, focusing on the enterprise software, hardware sectors, including cybersecurity, cloud computing, big data tech, and the mobile landscape. Dan is a highly sought-out tech expert globally. He's been a keynote speaker across the US, Europe, and Asia, and he is regularly, and I see him all the time, on CNBC, Bloomberg, BBC, ABC, CNN, and Fox to provide commentary related to his technology experience. He's often cited around the world by publications such as the Wall Street Journal, USA Today, Investors Business Daily, Los Angeles Times, Telegraph, and more. And it's an honor to have you on today, Dan.
No, it's great to be here. Thanks for having me on.
Yeah, Dan, thanks so much. And, as I mentioned here in the brief intro, you are on CNBC all the time. You're covering things from the tech sector and overall markets. But listeners tuning in, we have a Gen Z audience here. So anyone between that age of 18 to upwards of 30, and they come to the podcast, weekly or monthly to get mentorship from experts like you from all around the world. So I know we can look up your background on LinkedIn, but obviously, you weren't always a managing director. Can you walk us through a bit about who is Dan Ives? What's your background, growing up?
Mm-hmm. Yeah. I grew up in a New York area, and a core New Yorker, and ultimately then went to Penn State for undergrad. Big Nittany Lion, we are feeling good about the Iowa game this week. And, and then from there, I worked at HBO, corporate finance, in New York. I think like many do, coming out of college, and ultimately realized I really wanted to sort of double down on finance. Got my MBA from the University of Maryland, and then really started in late 90s, starting at FBR, Freedom Billings Ramsey, and really focused on tech. And that was late 90s. So that was really sort of the start of that bubble. So I saw the kind of end of that bubble, and then ultimately was there for the burst. And, really since then, I've been on the street, now for 20 plus years. And I think, look, it's one of those things where in this industry, I think you have to have a passion for stocks. I think too many people get into it sometimes for the wrong reasons, whether it's just purely money or prestige or whatever it is. And ultimately that kind of burns out. And I just believe like whatever you got to do, whatever you're doing, you want to have full passion doing it. So it doesn't even feel like a job. And that's always been sort of my view. And I love, what we do, our main goal, right? It's hand-holding clients, institutional investors within the tech sector, EV, disruptive tech. And it's been fun. It's obviously been, a lot of kind of twists and turns that I've seen over my career. But I think that ultimately it makes you smarter and maybe gives you more background in terms of navigating volatility, especially like what we've seen over the last 18 months.
Yeah. And it's, you have such a multitude of experience. You talked about kind of breaking into the industry, breaking into the street. Historically, when we look at companies like Goldman and all these investment banks, you typically need to go to a top target school to get into these companies that we've seen recently, especially. What advice could you give for someone looking to break in that might just be going to a community college or a college that might not be a target or even ranked?
And I think that was more of a historical. I don't know if that's necessarily today. I mean, I would agree if you go back historically, maybe there was definitely a kind of sort of stepping stone from top tier schools into banks and that. But I do think someone like myself, I mean, obviously went to Big Ten schools for undergrad and business school. And, and I think it's something where I see so many people in terms of my colleagues that have gone from schools to the best in the world to ones you've never heard of. And I think it all comes down to, do you have a DNA for stock picking? I mean, some of the best stock pickers that I've encountered in this industry, I don't care where they went to school. It comes down to, do you have the fervor and that special sauce? But I think ultimately it comes down to really having the passion. And I think, in terms of trying to get in or break into the industry, I mean, look, some of it sounds typical, like in terms of like trying to get an internship, try to get in front of people, whether it's LinkedIn or emails. But I think something that's really stood out to me is where I'll get contacted by, could be high school, college kids, or ones maybe coming from the military or just graduated college, and they'll just have a pitch on a stock. Sometimes it kind of goes against what even my thesis, but I think some of that, kind of just shows some of the passion, in terms of trying to break into the industry. And, and I do think it's kind of a new frontier over the next 10, 20, 30 years, because with so many different opportunities, not just on Wall Street, but across entrepreneurial, across tech, across crypto, 5G, AI. I mean, I view it as a fourth industrial revolution. I would almost say for like Gen Zers or even ones that are in high school now, like the opportunities over the next 10, 20, 30 years, it's going to be exponentially more than the opportunities for maybe someone like myself coming out of school, where it was typical career fair, internship, go to Kinko's and put the cover letter and resume.
Yeah, I mean, I think you're hitting it on the head there, right? Because even if you look at some of these top TikTokers, there's TikTokers making millions of dollars a year. You look at YouTube creators, it's ridiculous, right? How much money they're making.
But I think it speaks to the opportunities today, and I don't think it's necessarily that it's put into one sort of square peg or round hole. I think it's one where the opportunities are vast, but I think it comes down to passion, right? I mean, but also I think you learn the most, at least this is, my experience, you learn the most from your failures, not your successes. And I think adversity is something that's important to go through, because I do find sometimes, I'll encounter people where, they expect your success coming right off out of the gates, or whether it's financial or career or whatever it may be. But ultimately, I think, your failures are really what define your success. I think some of the most successful people that I've met, and, it's kind of a who's who, right? I mean, I could go from, Gates to Jobs to, across the board to billionaires. I think a lot of it's individuals that have had the work, the passion, the work ethic, but also I think it's also one that it's having a modesty too, as you're successful. I think that's important. I think there's too many people, whether it's in this industry or others, they start to get success and then they start to maybe get complacent. And I think that's something I see a lot of times, even like in tech companies, like they could have a huge advantage. Stocks on a 52-week high, everyone loves them. But maybe like they're discounting the competition, thinking that they're never going to catch up. And that S curve is pretty tricky, right? So I'm just saying, I think that's just a lesson for whatever you're doing.
Yeah. And, you've had this illustrious career on Wall Street, and you didn't get to where you're at without, I'm sure, your fair share of successes and failures, as you mentioned. I think that's huge. But, maybe can you share an example with us of maybe a stock that you picked that went south or failed, and what that lesson on failure taught you?
Sure. And you talk about failures. I mean, like, I think when I came out of college, I think I applied to maybe 70 jobs and got rejected from 68 of them or whatever. And it's like, and it's one of those things where, especially when I graduated, mid-90s, economy was kind of bouncing around, wasn't great, especially people that have graduated in the early 90s. It's similar to those that graduated like 08, 09 during the financial crisis, 2010. And I think it's perseverance that you sort of go through. But when you talk about stocks, I mean, especially as a stock picker, right? Because so many times when you meet people, maybe like on Twitter, Reddit, or whatever it may be, like, everyone's the heroes. They bought the stock at 5, sold it at 50, and they bought it back at 15. So, but when you do this for a living, there's no there's no gray, right? In other words, like everyone knows what your picks are. This, and I remember this going back to like 2003, something like that, 2002, 2003. When I first started picking stocks, like first initiations, I come out all buy ratings. It's like, these are the first stocks I'm going to cover as a senior analyst after being an associate. And literally all 4 of those names, like within 2 weeks, missed earnings. Stocks are basically cut in half. And I was telling my wife, I'm like, well, maybe it's, when maybe there's another career for me, like what once doesn't work out. And ultimately, I remember it was over a weekend, stocks were all cut in half, feeling down. And I'm like, okay, I feel passionate. I know my thesis is solid. I've done the work, double down. That Monday, I basically put out like a pound the table note. Most kind of dismissed it as just like, oh, there's no way you could buy these stocks. And I think over the course of the next year, all 4 of those stocks were either doubles or triples from the pre-sell-off. So I think that just taught me a good lesson about being confident in your thesis. Don't tune out the noise. And ultimately, like, in this job, like that's really what defines you. Like if I think about some of our probably calls that most people know us by, like being bullish on Tesla for the last decade. I mean, there were many times in there where, especially you hear from like bears, like super smart individuals, you're like, oh, maybe like I am wrong in the thesis, but ultimately like stood by. Like being bullish on Apple, going into like iPhone launches and thinking this was going to be the kind of next frontier. Everyone's like, this is just going to be another BlackBerry. So I'm just going back. Like, see, it's always very easy now to look at it. But when you go through it, like that adversity, it goes back to like, I think that's like that determines, I think, a lot of your success, especially in this job. Because there's definitely people that go through this job where it's like, okay, love it. Something happens, stocks like this. Okay, I'm out, like done. So it comes down to like, what type of analyst you are and how you're going to call these stocks.
Yeah, and I really hope the audience can take in what you said there, because there's times where you're going to be on cloud 9, you pick the best stocks, and then there's times where it goes the wrong way. And I think a lot of people, I don't know if you agree, but especially Gen Zs, we've been blessed in the last couple of years with a lot of these crazy high-flying names, AMC and GameStop, and people that, made a lot of money in that. But I think I just love that you highlighted failure to the audience, because that's key to being able to succeed. And so when you look at something, when you talk about outside noise and doubt and, negativity, you guys have been bullish on Tesla for the last decade. Traditionally, when you value a company, you can look at things like EV, EBITDA, PE, cash flow, etc. But how did you value Tesla? Like, how did you?
But that's a good example. Yeah, it's a good example. I mean, even like valuations, I think it's a slippery slope, because you might value a company differently than I do. But ultimately, what matters is how the street or investors are going to value it. And if I go back to Tesla as an example, we always, from day one, viewed Tesla as a disruptive technology player, non-automotive company. So we viewed it as like, okay, over the next decade, what's the opportunity? where can revenue get to? What the share that they could capture? Okay, now let's do a sum of the parts, value that, whether it's on a revenue basis or future cash flows. But I mean, I'll be the first one to tell you, I mean, and it's part of how we've always done it. Like, I'm not someone that ever gets caught up with PE and free cash flow, because I think with tech stocks, you have to look past that to where the opportunity. It goes back to like, had so many people miss Amazon because they were so not profitable. But where's the opportunity? It's why so many people miss Microsoft on the cloud transition. $30. Now the stock's $280. It's no different than missing Apple. And I could go through many names where with high growth stocks, you have to have the stomach, but also you have to have the ability to kind of triangulate your valuations, you know, when you're thinking about them.
One thing my generation struggles with a lot is when we get negativity or doubt from others, we're a generation that materially gets impacted by that. So within that, you know, I'm sure you had critics. I'm sure you had bad feedback. How did you stomach that? Was it just that conviction that stomached the doubt?
Yeah, remember, like when things go wrong in this industry, like it's not just like it's clients, it's internally, it's of course it's externally, you know, and then sometimes like on Twitter and some other, you know, different people contact you with not the nicest messages or whatever it may be. But see, I don't view it emotionally. I take the emotion out of it. So I think when you take the emotion out of it, it gives it a lot more like level way of kind of viewing the stocks. And I think it comes down to like when stocks sell off and things don't go your way, that also creates some of the best opportunity. I mean, I'm just giving an example, like Zscaler, our favorite cybersecurity stock, like stock went from like 70, 80, like kind of had like a quarter where they didn't raise guidance. I think it went to like 45, maybe like a year and a half, 2 years ago. It's 250 to get today. But then at the time, like when you're doubling down, everyone's like, this thing's going to 20, this thing's going to 10. But so it just speaks like that's why you have to do your own work and your own thesis. And like, but you're gonna be wrong, right? Like it just comes down to you're gonna be wrong. But those failures are ultimately what help you succeed, especially in stock picking, right? Like maybe if you look in the market now, the consensus is tech's bad, 10 years moving higher, tech's going to sell off, Fed could raise rates, whatever. Just keep going to all the sort of noise. But those exogenous events in my lifetime have created some of the best opportunities. I mean, I'm going back to like, remember I covered bubble, burst, 99, 2000. I've been through financial crisis, 07, 08, 09. Like, going through 2011, 2012 situation where a lot of these stocks sold off on European worries, and then obviously just going through different issues. And then even during COVID, right? I mean, when COVID happened in March, I mean, we can't just sit there being like looking at our screens, being like, I don't know what to do. I mean, that's why as soon as COVID started and everyone's locked down, like that mid-March, I think we put out a note maybe like that day or next day being like, this is the time, like this is the time to kind of double down tech. Eventually we'll all move to cloud, virtual, and at the time everyone's like, that's crazy. Like, but I'm just trying to give you examples of these create opportunities, but also it's patience. It's understand you're going to be wrong. And I think that, that ultimately makes really good stock pickers. And I think it's something too, like, especially in this world with Reddit and social media and message board. I also think sometimes like too much information is sometimes a negative. Because if you go back many years ago, there wasn't as much information. So information flow, I mean, that was a huge part of like being in Wall Street, and, where I think there was, I think there were a lot of sort of opportunities, from an information for, if companies were at conferences, retail investors didn't have webcam. Remember, that goes back to like Reg FD, and everything got webcasted, and now it makes a much more even playing field. But on the other hand, I think now like sometimes there's like too much information, too much noise. So I think sometimes tune that out, it helps.
Yeah, and like you mentioned, social media has taken over now. You can go to TikTok to learn about stocks anywhere, and so there's a lot of noise there for sure.
And that's a good thing. It's a good thing in the fact that you can learn. Like there's people that can just ramp on stock, and they don't have to be going to business school or in college. They could do it themselves. But also I do think like it's dangerous too, because someone reads a book or they watch something on YouTube, and all of a sudden they think they're like, stock picker of the century, have a stock that works. Oh my God. Like I'm I know everything. Yeah. And then all of a sudden, like, it goes bad pretty quick. So I'm saying that's why I think it's just important to just like from whether it's the modeling part, whether it's understanding Wall Street, whether it's, having passion or in the sector, just to do a ton of work.
Yeah. Yeah. And how has, picking stocks for as long as you've picked them now, how has picking a stock that either the company failed or just missed the consensus of what you were aiming for and you had to, take it out of the list or whatever it may be, how did that impact, has there been a situation like that that's impacted your fundamentals going forward that's actually made you a better picker?
Well, I think when companies miss earnings, the question, and when I say missed earnings, I don't mean like crush revenue, miss EPS because they're investing too much. Streets focused on growth, stock will be up. But like when something happens in a quarter where a company like misses growth or they miss the whisper numbers, the question you always have to ask yourself is, did this change my thesis on the company? And I think that's important because it's like, now maybe something happens, like they lost a huge deal, a product didn't come to fruition, competition, a CEO leaves, or someone that was, key to the story, could be a thesis changer. I think the other danger, and I think another kind of like, what I view as a core tenet of mine, it's like, don't just hang on to your losers hoping with a hope trade. Sometimes like if you missed it and the story's gone south, cut it, done, move on. The other thing is like never underestimate how good a management team is and just how important. And then also like never overestimate just how bad a management team could be. So I think that's like, those are just two things that are like very important. Like when you're looking at stories that I think sometimes maybe like not as appreciated as much.
Yeah, no, that's extremely powerful, and knowing when to cut your losses is key. You mentioned a lot of it, like management team, looking at the earnings, looking at, is it just a miss on
sector, competition?
Now, how do you know though, outside of that, when to cut your losses? Like you look at like a company like Hertz, people might have been buying the dip on that stock for 7 years. How do you as an analyst find those early signs that tell you, oh my gosh, this has changed, I need to cut my losses?
Well, I think a lot of it is like, okay, like in my sector in tech, it's understanding, where the growth's coming from, talking to a lot of CIOs, CISOs, doing a lot of surveys, listening, reading transcripts, even companies you don't cover, understanding some of the sector growth drivers. So I think sometimes it's trying to understand like, where's the growth going? Is this starting to compress in terms of growth? Is competition changing? I mean, sometimes just as a good example would be like let's say like if you look at cybersecurity or networking. Like if I go back years ago, it's going back like 6-7 years ago, like there was a view like, okay, Cisco is losing share in security, because you could just see it on their public numbers that they were reporting. Where's that share going to? Okay, like who's winning there? Like our view that it was Fortinet, FTNT that was winning, and that's, even though it's not such a high profile name, like that's probably been one of our best calls. I mean, the stock went from 40 to 300 or whatever in the last 4 to 5 years. But that was really a call that was really predicated on, okay, there's share losses. Who's gaining the share? Sometimes it's like there could be new companies, they're having massive growth. Is that organic? Where are they gaining share? Like on LinkedIn, like where are salespeople going to certain companies? Like why are so many salespeople leaving this company and going to another? So sometimes it's putting that all together, and it's complex, right? And you're going to be wrong sometimes. I mean, you'll get me wrong a lot, but it's that's sort of our philosophy when it comes to a lot of these names.
And, you mentioned organic growth. Is this growing because of this or not? I mean, you look at something like Zoom stock traded as high as 600 a share. It's trading today around 250, 260. So down 60% plus from highs. As an investor, isn't it really important to highlight what you said there? Because you don't want to get caught in that rotation, right? If you're buying at all-time highs, especially with Zoom coming off a quarter where they had, I think, $1 billion quarter, but they have, they cited headwinds going forward. You have to be able to see exactly what you're saying there. Is this growth organic, or was a lot of this perplexed or pushed due to a COVID, right?
Well, push for, but then on the other hand, with Zoom, it could be like, okay, I'm just giving you two sides. It could be like, okay, the stock got overextended, sold off. Now, let's say there's a view like, okay, like, can they further capitalize from collaboration to other areas? How penetrating is that? It is now the hate selling that's creating more and more of an opportunity. Maybe not, but I'm just trying to explain an example of it's sometimes when you get too caught up in the momentum, I think sometimes it's dangerous because it skews your view if you're sitting there looking at the screen the whole day. And I think sometimes that's why, like I said, I think it's doing your work, doing the thesis, having names you want to own. And I think it's having like longer term names, so maybe sometimes shorter term names. But that said, like, some that try to just trade in and out of earnings, I mean, those are dangerous games because everything could go right. Company beats whispers. And the stock just doesn't react, maybe because of macro or technical issue, whatever it may be.
Yeah, and I think it's so important that you highlight that because some people are just looking for those short-term swings or whatever it might be. Now, we're really just trying to, the reason there was a lot of excitement about your episode was we're just trying to get into your head as a stock picker, right? Because you've had such an illustrious career. What about, you've covered Apple for a long time as well in your industry. What's the case now? We want to understand what you think when you look at the next 5-10 years, not necessarily about where Apple's going to go, but fundamentally, what's the case for Apple to double from a $2 trillion market cap to $4 trillion? Some would argue that it's reached its peak as a company. What do you look for key things to be like, no, there's growth here?
Yeah, and people said they reached their peak 5 years ago, and they reached peak 2 years. So that speaks to a historical view. I mean, look, Apple's an example of like, some will be like, okay, innovation has slowed down. I mean, if you look at Apple and you look what's happened with their iPhone, I mean, you're talking about a company that's going to sell, give or take, 230 million units this year, just of iPhone. That refresh cycle every 2-3 years. And now more and more control of their ecosystem with chips and which continues to be a super cycle that I still think is underestimated. But with Apple, the story is, if you go back to BlackBerry and Nokia, two like high profile, legendary failures, essentially, of massive hardware businesses that eventually just, never could succeed past hardware. So with Apple, it comes down to like, it's all about monetization of that services. And today that's only 15% penetrated. So when you think about what drives Apple over the coming years, too many times everyone's like, what's that next product? Is it an Apple car? Is it AR/VR? It's monetization of services. And that iPhone cycle now much more in a steady state 2-year cycle. That happens, numbers are probably underestimated by 10 to 15% by the street. Multiple. Then there's a good example. Apple, in my opinion, you don't view it PE. You view it, what's the value of services business? What's the value of hardware business? Put that together, you have anywhere between $3 and $3.5 trillion valuation. And what does that mean? Between now and then, China headwinds, supply chain, chip issues, whatever it may be. It's not going to be smooth, never is. But that's the opportunity.
That's key there. But what about on the contrary? And I remember we saw recently Apple had lost the case about the App Store purchases, which is a large.
So that's a good example. Like, let's like when that happens, right? So it's just like Epic, they lose. Everyone's like, oh my God. Like that's one, like when you do the math on that, worst case, 2% revenues goes away. Base case, 1%, 3 to 4 billion. Because the reality is that the vast majority of Apple users, when they're buying in-app, they're going to continue to go through App Store. I mean, that's just the reality. And it's something where too many times with court cases and some regulatory, look, I mean, we're going back to Facebook. I mean, Cambridge Analytica coming out of the elections, 2016, Russia, they're having all the hearings. Is this the end of Facebook? I mean, look what the stock did, okay? And now it's, what is it? 6-7 bagger from then. I'm just trying to give you examples of one where, like, if you focus on the hate, but like worst case, but then if you do your work and you kind of do stress testing of model, that's ultimately what separates the winners from the losers.
Yeah, no, 100%. A lot of gems there. And I think when you conceptualize that and you actually quantify it there, what's the worst case here? Is it 1%?
But that's a good
2%?
example. Like when that as soon as that happened, when that case happened, right away, like phones ringing off the hook. Everyone's like, everyone's going crazy. All like the bears, they'll start to be like, this is it, App Store. They're going to lose 70 billion. And then we came out with a note next day being like, it's 2%, it's probably 4 to 6 billion, worst case, base case, 3 billion. That's a rounding error for Apple.
Yeah.
So now look, then there's examples like Uber, Lyft, driver shortage, pricing surging, contractor versus employee debate. Okay, like you can't just push those aside. Like those are structural things that you gotta, take into account. And has that changed the valuation? I'm just trying to give like examples of you can't paint them all with the same brush, but that's an example of like that happens. Like, okay, like, and sometimes there'll be things like I'll get into like Ubers, traveling a lot, especially like since, May or June, I'll get into Ubers and talk to drivers. What are they seeing? What's pricing look like? Like a lot of promotion. So sometimes like the due diligence that you could do, I mean, it goes back to like, I've worked with plenty of retail analysts over my 2 decades. Like, they go to malls on Saturdays and go into stores and where is inventory and is there, glut of denim or whatever. I'm just saying, like, that's grassroots type stuff that there's a lot of that opportunity out there.
I think that's key that you bring up that too, because a lot of times when people are sitting down and you've been giving us a master class, so thank you. But a lot of times people sit and they go, what's the PE? What's the high? What's the low? What's the
But even
fundamentals?
like, I'll give you an example. Like, I have a 14-year-old son, a 17-year-old daughter, and my 14-year-old, like, sometimes like my kids, like, I'll see them like buying things, and I'm like, I'll give you an example. Like, I noticed like my son, like Under Armour. Like, I just noticed all of his buddies like were buying Under Armour. Like, no matter what, look at that, where that stock was. Stock was getting crushed. So that's a good example. I'm just like, remember, this is just like unanalytical. That's like, look, I'm seeing like in this tween category, like massive buying of that. Okay, let's do more work on that need, whether it's PA name or whatever. So, I'm just trying to give you examples of like, sometimes right underneath your nose, there's tidbits that you don't see that kind of speak to just massive, opportunities. And I think, like, I've had the opportunity to travel, for many years and see a lot of different things. And the more people you talk to, you tend to, I think sometimes it's able maybe like to piece it together better. But I'm just trying to give examples. Like, every stock has two sides of an equation, right? And that's the opportunity.
And now that I think about it, a company like I look at AT&T and T-Mobile. I'm a T-Mobile user, and I remember over the last 6 years, I switched from AT&T because one thing I noticed is they outsourced their customer service. Terrible time with customer service. When John Legret took over T-Mobile, I noticed the culture, the customer service. I look at the 5-year chart of T-Mobile versus AT&T. You see a clear difference.
No, but
Both
that's a good example. I mean, I'll give you another example, like Domino's Pizza. For many years, like the stock, they had, the stores had all trouble. Like, all of a sudden, like, I ordered Domino's, and like the app, and they were giving you updates like where the pizza is, and I'm like, this is different. Like, this in a good way. Like, and then you get the pizza, and it was actually really good. So, like, even though that's just like one experience, I'm just trying to give you examples, even outside tech or in other areas, where like there's opportunities sometimes like that, like, and it's no different than like if you look at like, we're not talking stocks, we're talking about just entrepreneurial, like, even if you think about like quick deliveries in New York City, like more and more like I was starting to hear about like 15-20 minute deliveries. Now you said the ultra quick sort of food deliveries, or whether it's snacks or liquor or whatever it may be. I mean, that's turned into $100 billion market. So like, if you saw that 4 or 5 years ago, and we're able to kind of get funding and work through the logistics, like, those are some of the great opportunities. So I'm trying to take it outside stock picking too.
Yeah, and I think that's key that you're really letting us dig deep into see that it's not just stock picking. You can relate this to business, to where you're going to go to college, to your career, whatever, entrepreneurial. Now, what about on the flip side? So another example, obviously, you guys have been bullish on Tesla for the last decade. You guys are famous for that. When you look forward, Tesla, whatever it's trading at in the 700s, close to that 52-week high, what do you do when you start doing an analysis and you see, Lucid is becoming the hot topic now? Analysts are coming out and saying it's the next Ferrari.
But that's a great thing. See, that's not a bad thing. Like, it goes back to like, there's 3 million EV cars in the world today. It's going to go to 50 to 75 million. It's not just it's a green tidal wave. So it speaks to our bullishness over on electric vehicles, but it's the view of like, where is it all heading? You can't just look at companies quarter to quarter. Do companies quarter to quarter, it's it's very like myopic, to kind of do that. But I think when I look at like electric vehicles or artificial intelligence or 5G or other areas, like, there's massive opportunities there.
Yeah. And 100%. So I think I like that viewpoint where it's like when you look at, oh my gosh, someone might panic and be like, wow, Mercedes is doing it, Audi's doing it. Wait, what? This is actually good. This is bullish for the sector. I think that's the key point to look at it that you're mentioning there.
Or it's like, okay, like if you were able to see like 2 years ago, like, hey, Ford, GM, they're getting more and more into EVs. If they're able to convert 10%, Ford, GM, these are huge buys. If I go back the last year, and it's still my belief that is there. And we look at the charts of Ford and GM. So I think it's important sometimes to kind of see things that maybe at first people might, disagree with.
Yeah, and that's key because don't you got to ask yourself as an investor, this is the stock price today based on all the public information we have. What is the market discounting? What is the market missing that I see here? Isn't that the key to being a good investor?
Yeah. And sometimes like you might be wrong on the first blush, but then there's the opportunity if you stick with it.
And you've been through, like you mentioned yourself, '01, you saw the tech bubble, you saw when stocks get really hammered, 80-90% for some names, and then you saw the financial crisis. You saw names like Citibank trade under $1, like crazy things, right? So
But those experiences, not to cut you out, but those experiences, I think they really give you, I think, significant value as you go through any period of volatility.
Yeah, and I think the point I wanted to make there is those type of experiences sometimes can, you mentioned it, make or break careers. Some people quit. We saw actually, unfortunately, suicide rates in '08 for a lot of investment bankers and things that happened. But you've survived both of those, and you're in a higher position now. How'd you do that?
Well, because I never viewed it emotionally. See, I view it as like, there people, I've seen so many good things, but I've seen so many bad things, happen to different individuals in this industry or other. And I think it's important to just, if you stay unemotional and you keep things in perspective, that it's stock and it's not life or death because you're picking stocks, I think it makes you less emotional. And I think that's why, like, if you're less emotional about it and you have a process, it makes you, I think, ultimately a better stock picker. But like, look, in terms of how I survive on Wall Street, going back from 99 to today, I think it's one where like a lot of it is like, what's your value to clients, right? Like, it's like, because I think we've always we wake up every day trying to be better. So I'm just telling you like how I view, like, I've never viewed it as like, I'm going to break my arm, pat myself in the back. It's like, okay, how do we get better? Where are we wrong? Like, could I work harder today? Like, if I get off talking to you like tonight, like, could I do a little more work? Because maybe there's some names where there's opportunities. Or instead, do I watch Netflix? Then maybe I watch a late. But I'm just trying to like explain. Like, sometimes it's like, it's that little incremental that sometimes makes a difference.
So it's just like the way stocks compound over time. You got to compound your daily success habits.
Yeah, and I think also it's like sometimes like it's also about like, it goes back to like, you got to like step away from it. And I think sometimes like if you're on social media too much, I think it can negatively influence, especially in stocks. Sometimes like I think it's important to understand what's happening. But I think sometimes like tuning out the noise and focusing on the fundamentals, I think that creates opportunities too.
Right. And did situations like '01 and the Great Recession of '08, did that prepare you when you saw a 40% crash in March where people a lot were panicking?
Oh, I mean, that was massive. It's unprecedented. these stocks could go down another 50%, like, how people going to work. I mean, if you just go back, and given all the obviously like horrific death, destruction, but that's a good example. Like if I just go back to like even some of those notes from March 2000, I think we were writing like twice a day. It was just like, these are names. This is the basket. This is our COVID basket. Like these are names you own. And I think because I think also our value is when things get sometimes when things are bad and volatile, that's when people also, I think listen to you the most.
And then, the central talk that you've given us, if I had to take away something from this podcast, is you talked about emotion a lot, which is one of the biggest keys, is understanding your emotion, your discipline. Someone might post a tweet or a TikToker and they might say, Dogecoin or whatever the heck it might be, but their loss is, whatever that post is, they're themselves. But I feel like you almost have to be even stronger with your emotion, because you're in situations when you're writing notes, you're dealing with clients, institutional money. If picks go wrong, I just think
and when
that's
they
so
go
impressive.
and they go, and when stocks go against you, it's like, do you downgrade or do you double down? And I think some of our best calls have been when stocks crater because of a specific and then ultimately us basically doubling down, be like, this is the time to go all in.
What's an example of, as we get into the closing side here, what's an example of a stock that you downgraded that you were previously bullish on, and why did you downgrade it? Maybe that could help us learn.
Downgrade that I was bullish on. I mean, Nikola was an example of a company we weren't bullish on, but we downgraded to a sell. We did when we were neutral, downgraded to a sell, just because I felt like they had to navigate through some of those issues that they went through. But then fundamentally, I think seems like they're being able to navigate that pretty well. I mean, look, there are definitely companies over the years where you feel like they get overextended. Maybe you downgrade, stock gets hit, and then ultimately maybe there's other entry points, right? It just goes back to you could cut your losses, but even on high flyers, you could take some profits along the way. And I think some of the best investors, that's kind of their philosophy.
And I think what I'm learning from our conversation is investing is not one thing or one size fits all. It's there's an art to it, like basketball or anything. You got to strategize.
Look, and that's why some of the most successful people that I know in this business, a lot of them are they might have been former military, athletes, Division I or Olympic athletes, former coaches, very maybe motivated individual, I'm just trying to give you an example of it's more, it comes down to it's more than where you went to school, and if you went a purple tie or whatever it may be, or a bow tie. I think there's a lot that goes into being successful for stock picking.
Yeah, and what I love about your answers is you relate it back to, that was the first thing I asked you. If you don't go to a target school, how do you break into the industry? And you were just related it there again.
And I think that's one of the fallacies or whatever, is there's people I didn't graduate from XYZ school, so I can't get in. And that's, I think that's just I think that couldn't be further from the truth, because I think it goes back to I mean, there are people, I mean, I can tell you stories. I mean, I remember one time I was taking an Uber and there was a driver and we were talking, this person's super smart. They're dialed in. I ended up getting them a job in Wall Street. Wow. Because I felt that passionate. So I'm just trying to, And I like, it was just like something special about this bird. I'm just trying to give you an example. I think
Wow.
that's important.
And so from that ride, you were able to get them the job?
Yeah.
Wow.
Yeah.
Wow.
So that was a good Uber ride for them.
It worked out for them, right? Yeah. And obviously you've talked about a lot, EV, Apple, chip, what you see for the future, but just curious to pick your brain a little bit. When you look for the next 10, 15 years, what are some areas that you see of opportunities for growth that maybe a lot of us don't see?
Yeah, and I'll go after this because just have the Zoom I have to be on.
Yeah.
Look, I view this as a fourth industrial revolution. I mean, to me, I think in specifically cybersecurity, I think there's going to be some massive opportunities, cloud, EVs. And I think even like on a lot of these like EV SPACs, like, they're pre-revenue, some are dismissing them. They're going to be helping build out the whole green tidal wave supply chain over the next decade. So and there's huge opportunities there too.
Yeah. Yeah. Well, Dan, look, I appreciate that. I know you got to get going here. We appreciate your time. That's Dan Ives,
Thanks for having
Managing
me.
Director. Thank you for all the advice and helping Gen Zs today. It means a lot.
Good luck. Thank you.
Good luck.